Buy a house now. Hey everyone, it's Wolfgang. So a lot of people want to buy a home. A lot of people have been blocked from buying a home because interest rates are stubbornly high. This will present a solution to that problem. So if you're thinking about buying a house, stay tuned because we will go through what to do. Home loan rates are high. Many get stuck in the qualification process, often for income. Income's just not high enough. Oftentimes it's barely not enough income. Monthly income and the payment total compared to all your other bills, it keeps a certain percentage of people out of the market. It keeps a certain percentage of people being renters when they would prefer to buy. So there is a way around this. Okay, a lot of people have not been thinking about this compared to past times. So this is going to present a new way of thinking about the home loan process. Getting an adjustable rate mortgage. So there is a negative connotation with ARMs, with adjustable rate mortgages. Historically, they caused some problems in the past. The problem now, though, is interest rates are high. They're about 6.4% for a 30-year fixed rate loan. So when you try to qualify for 6.4%, and the lender looks at all your bills and your income, you may not qualify at 6.4%, but you could easily qualify for 5.7%. And that's what adjustable rate mortgages are right now. A lot of people have not thought about this path because of the hangover of the very bad reputation that adjustable rate mortgages have. It comes from the 2007-2008 housing crash. The bad reputation of an ARM is over a decade in age. It's over 10 years in the making. If you don't qualify for a 30-year fixed rate loan, you may easily qualify at 5.7%. Because right now, a lot of people, they would prefer getting a 30-year interest rate loan for 5.7%. It's going to take a while to get there. Maybe next year. I don't know. Probably within the next 12 to 48 months, we're going to get to 5.7% for 30-year fixed rate. But you don't have to wait. You don't have to be a renter for the next 12 to 48 months. You can buy now with a 5.7% adjustable rate mortgage because they have changed. Changes have been made to make them safer. About 10% of home loans right now are adjustable rate mortgages, only about 10%. So 1 in 10. So 90% of people, when they buy a home, they're getting 30-year fixed rate loans. Only 10% are getting adjustable rate loans. Back in 2007, 2008 crash, it was much higher. The adjustable rate mortgage percentage was way in excess of 10%, much more than 1 in 10 people. They were very popular. They were called no-doc loans, and they had problems. Back in 2007, 2008, before the crash, adjustable rate mortgages, they were very easy to get into. There was very little need to document your income, believe it or not. I know that's hard to believe now because standards are much different. So why did adjustable rate mortgages get a bad reputation? Why do they have a bad rap? In their heyday, 2007, 2008, the monthly payment could skyrocket at the end of the lock period. So you'd go into an ARM, adjustable rate mortgage, with a certain interest rate. At the end of that period, the first 3 years, 5 years, the amount of your monthly payment could skyrocket. And I mean just a huge increase. So there were loans back then called negative amortization, no-doc, adjustable rate mortgages. Okay, that's a lot of verbiage. What it meant was not only would you have a low interest rate, an artificially low adjustable interest rate that would be locked for 36 months, but your payment could be lowered if you wanted it to. If you told the lender, look, I want a negative amortization monthly payment, they would lower your monthly payment, but automatically add to the loan amount that you owe the monthly amount that you're not paying. So in other words, a negative amortization ARM, maybe your normal monthly payment would be $1,000. You would tell the lender, look, give me a $500 a month payment. They would take the other $500 and add it to the loan that you still owe. So at the end of the lock period, your monthly payment would skyrocket. Okay, so negative amortization loans, no documentation loans are gone. The rules have changed. So adjustable rate mortgages are much safer. They're much harder to get. So the motive to buy now with an adjustable rate mortgage, okay, You can buy now. You don't have to wait. You don't have to keep renting for the next 12 to 48 months. And with a low interest rate, 5.7%, that is a screaming good interest rate right now for a home loan. 5.7%, people dream of that rate. You can actually get that with an adjustable rate mortgage and with a safe, relatively safe adjustable rate mortgage. The rate is locked between somewhere between 5 to 10 years. The rate will be a low interest rate, 5.7%, 5 years, up to 10 years, depending on the lender and the loan product. So you will save huge money on your monthly payment, okay? The benefit is you will be able to qualify for a home and you'll save a lot of money in monthly payment. And then you'll be able to refinance because we just entered a declining interest rate cycle. The Fed just lowered rates and the Fed announced they're going to lower rates more than once in the near future. So we just entered a declining interest rate period, right? So the tactic is, or the strategy is to buy a home with an ARM 5.7% now, and then, because we're in a declining interest rate cycle, refinance to a 30-year fixed rate loan in the next 12 to 48 months. So you buy now with a low interest rate. We're in a declining interest rate cycle, so rates should come down. You can refinance in the next 12 to 48 months. So only 10% of home buyers are taking advantage of this right now, because until a couple days ago, we were not in a declining interest rate cycle. It was not at all clear what direction the Fed was going to go with interest rates. Okay, but that mirror that was foggy has been cleared, and now we know that we just entered a declining interest rate cycle. So it's much safer to buy get an adjustable rate mortgage because you're probably going to be able to refinance, strong possibility, in the next 12 to 48 months. So that's what the Fed lowering interest rates and entering a declining interest rate cycle has done for the adjustable rate mortgage. It's made it much more attractive. The cool thing is you cannot get a negative amortization loan, and you have to qualify. You can't just, back in 2007, 2008, if you could walk and talk, you could get an adjustable rate loan, no doc, negative amortization, and then your monthly payments after 3 years would just become unaffordable. So what that did in 2008, 2007, 2008, there was this activity called the strategic walkaway. People saw that, okay, all of a sudden my monthly home mortgage payment has skyrocketed, but the home value has declined because so many people are defaulting and not making payments. So I'm going to stop making payments on my mortgage and give the keys back to the bank. What that did, there were so many people doing that strategic walkaway activity, it depressed home prices. Home prices crashed. That cannot happen now because you cannot get a negative amortization loan. You cannot get a no doc loan. You have to qualify for these loans. But the cool thing is you can qualify at 5.7% now. That was the rate as of yesterday, Friday. We just entered a declining interest rate cycle. Okay, so I couldn't fit everything on the board. What are the differences between the days when the adjustable rate mortgage started getting a bad reputation? What's the difference between then and now? I've already mentioned that no documentation loans were available back then, 2007, 2008. You didn't even have to show proof of income. I know that sounds hard to believe, right? No doc loans. If you look that up online, no doc loan 2007, 2008, you will see that they existed. Qualifying for loans is harder now. So there's no way for ARMs to create the same kind of massive strategic walkaway declining home values problem that was created in 2007, 2008. That cannot happen. Also, you have to have a legitimate down payment. You have to have decent credit. And you have to have enough income to qualify for 5.7%, right? There are stricter regulations, higher borrower standards compared to 2007 and 2008. Okay, so what do you need to do to actually get an adjustable rate mortgage? Step one, you've got to have income that can be verified. The lender will verify your income. Step two, you've got to have a decent credit score. Usually that means, well in excess of 600. Some lenders, they want 640 or higher. And you need full documentation you have to go through the standard qualification process. It's just that the thing that has changed, we just entered a declining interest rate cycle. So getting an adjustable rate mortgage now, you have some certainty you're going to be able to refinance in 12 to 48 months. So we're in a period of time now where it's possible to buy a house instead of continuing to be a renter. So it's something to think about. If you have any questions about this, this is great news. The kicker was we just entered the declining interest rate cycle, period. And only 10% of home buyers now are using ARMs. That's going to spike. That's going to increase because of this, because of the declining interest rate cycle. People are going to catch on to this. Okay, I'll get the ARM now, then I'll refinance in the next 12 to 48 months. I'll requalify for a fixed rate loan. That's the current plan. So if you have any questions about this, I was buying real estate in the 2007, 2008 timeframe. So I know what conditions were like. Ask away if you have any questions about that. I'd be more than happy if you post questions in the comments to answer those. And I really want to thank everyone for watching. Have a great day.